Hello, everyone. Welcome to today's episode of our Tanker Market podcast. I'm your host, Shruti, and joining me today are Sandesh and Trisha. We'll be covering key developments in the crude, CPP, and LPG sectors for week 47. So let's dive right in. Having said that, Sandesh, let's talk about the crude oil market first. Please tell us what's the overall picture in the VLCC and Suezmax segments?
Well, thanks Shruti for inviting me. When we say that the crude oil market, we have to first start focusing on the MEG market. So the VLCC market last week in the Middle East Gulf market gained some early momentum. That is in the last week, and it was well supported by balance in tonnage supply and the anticipation of December cargoes. And having said that, the anticipation gave owners some leverage and it allowed them to hold firm and resist charters. But however, in the midweek, we saw a significant shift in sentiments as charters were able to apply pressure because they were securing some fixtures below the level seen earlier in the week. Overall, this led to a slight downturn in freight rates, which we observed last week, and that has raised concerns about the uncertainty that still lingers in the market. We thought that high volatility and uncertainty are key themes right now, and cargo volumes will be absolutely critical in determining the market direction in the coming week. Now, this is about MEG market, but the fundamentals were almost similar in the West African market. So in the XWAF, VLCC had a stronger start at the start of the week. But as the week approaches the midweek, the rates dropped below World Scale 60. And it was influenced by a subdued market as well as the decline in the inquiries and increase in tonnage availability. So there is a lot of uncertainty in the WAP market also, and market participants, specifically charterers and both ship owners, are waiting for clearer signals to gauge where things are headed.
Right. So, what about the Suezmax segment?
Well, the Suezmax market showed a bit more stability, particularly in the XMEG region, that is Middle East Gulf region. We have saw rates gradually edging higher week on week, and it was supported by continued demand for India-bound cargoes. And the ship owners in Suezmax segments were able to hold firm and resist further rate decline. And this has helped to maintain some stability in the market. However, the overall activities, that is the requirement of cargoes and fixing of ships, remains moderate, and that's why the market participants are closely watching to see if momentum can be built further. Now, on the WAP side, that is West Africa, we saw a mix of strength and volatility with the freight rates rising in the midweek but easing slightly by the end of last week. And overall, the Suez market is benefiting from some stability, specifically in the WAF region. More owners begin to show resistance to rate declining, and that has prevented a more severe downturn. While the segment in the Suezmax is steady, but it's clear that further inquiries are needed and that may push the market higher. The market is still in a wait and see mode, and we could see either further gradual increase or slowdown in the activity. And it will be all depending on what happens in the coming days.
Thanks, Sandesh, for elaborating on the VLCC and the Suezmax segment. Now, can we have a quick look at the Aframax segment?
Well, thanks, Shruti, for the Aframax question. The Aframax tanker market remained under pressure across key regions last week. Uh, Having said that, both Middle East, Gulf, and Southeast Asia market, those facing subdued activity. In the Middle East Gulf, the TD8 index, which is a benchmark route, it continues to decline amid consistently weak demand and ample tonnage supply. And it has forced owners to accept part cargoes due to lack of full load opportunities. And in addition to this, the geopolitical tensions, it has further affected charters, and overall it continued to adding some bearish sentiments. We have seen some few private fixtures, but it failed to offset any downturn. Now, having said about Middle East Gulf market, the situation is similarly in Southeast Asia market, and there was also activity was muted, and it was majorly due to weak demand from Indonesia. At the same time, the tonnage was also abundant because the market keep sentiment softer for ship owners, and without a significant increase in inquiries or cargo availability, the market across both regions is expected to face continued pressure. And having said that, we can say that Southeast Asia, the rates for Aframax potentially nearing around world scale 125 levels in the near term, specifically in the next week or so.
All right, interesting insights, Sandesh. Now, I would also like to add on to that. So, the TD2 and TD3C rates both saw declines by 4.4 and 4.2%. On the other hand, TD15 saw a slight increase, rising by 0.2%. We also noticed Indian PSUs quoted fewer cargoes. So, it looks like there is a bit volatility ahead. All right, moving on to the CPP sector. I'm curious about what's happening in the LR and MR markets. So, Trisha, can you break it down for us?
Sure, Shruti. The CPP market, it has been showing some promising signs, especially in the LR segment. For example, on the AG Japan route, freight rates for LR1s they climbed by world scale 5 points to 110. Now, although it is a small, but it is a solid improvement that reflects a firmer market sentiment. Similarly, for LR2s, rates saw increase by world scale 5 points to 101. So their earnings were even more impressive. So all in all, the LR segment is looking pretty strong right now. Now, as for the MR market, the gains were modest but still somewhat encouraging. For example, on the Sikka Japan route, rates ticked up by world scale 0.9 points to world scale 119. So overall, the CPP market performed quite well.
All right, so that's some good news for the CPP market. And how about refinery margins? Are they driving this uptick?
Absolutely. So the refinery margins were playing the big role. In Singapore, we saw a big jump in margins last week, especially for gasoline. The Dubai cracking margin averaged $4 per barrel. So it's definitely a healthy increase. And get this, the 92 RON gasoline margin, it shot up by $1.1 per barrel. So that was nearly a 20% increase in just a week. So that's a clear signal of strong regional demand for gasoline. And over in the USGC market, it's been a mixed bag. So gasoline inventories went up slightly by 2.05 million barrels, but they're still well above the 5-year average. And as for the refinery throughput, it dipped by 1.3% week on week. So refiners were feeling some pressures. But despite that, the overall outlook for the CPP market, it particularly for the LR1s and the LR2s, is looking positive with strong demand for refined products, and that is what is driving the momentum.
So now I've also heard about China's decision to reduce the VAT rebate on exports starting December 1. Right, so that sounds like a game changer. What's your take on this? How do you think this could shake up things globally?
Great question, Shruti. So China's upcoming policy change is definitely worth watching. Now, starting December 1, 2024, they are reducing the VAT rebate on exports of gasoline, gas oil, and jet fuel from nearly 13% to 9%. So, actually, this is part of a broader strategy to focus on domestic growth and consumption, also while pulling back on export incentives for Chinese refiners. Now, concerning the CPP market, this could have a big impact. Export margins for gasoline could shrink up to $3 per barrel. Now, that is definitely a significant hit. And considering China's role as one of the largest exporters of refined products, this policy could shake up things globally. In fact, experts are also predicting that Chinese CPP exports, which were expected to stay around, let's say, 41 million metric tons in 2024, might see a decline in 2025. Now, if that happens, it could alter trade dynamics and even push up costs. So it's definitely something we'll need to monitor closely.
Sounds like a lot of moving parts in the CPP market. Thanks for breaking it down, Trisha. Let's keep an eye on how these things or developments play out. Now, turning to the LPG market, today we again have Akhilesh, who handles LPG broking at Saigal Sea Trade. Welcome to the podcast, Akhilesh. It's a pleasure to have you as always. It seems like there has been some pressure on freight rates lately, especially in the east of Suez region. Could you break that down for us?
Hi Shruti, thank you for having me again. So yes, according to the current market sentiments, the east of Suez freight market has been under a bit of strain lately. Despite a noticeable discount on TCE compared to the west, the market hasn't really gained much momentum. Freight rates have remained flat around $50 per metric ton for Rastonra Chiba route, that is a BLPG1 route, which is lower than what many market participants have hoped for. The main challenge here is an oversupply of vessels, particularly those that can only operate on eastern loadings, which limits the flexibility and market pressure. This has kept the BLPG1 index stable at low levels. Many owners are hoping that cargo's volumes will pick up in early December, and if that happens, for instance, it could tighten up the market and push rates higher. But without that increase in the volume, it's unlikely that we'll see significant upward movement in the near term. Some cargoes have been quoted for the regions like Western Africa, Australia, and the Red Sea, but the market is still predominantly focused on the traditional MEG loadings, which is keeping the rates in between like high 40s and low 50s per metric ton. It is certainly a market in waiting.
All right. So, how about the west of Suez market? Is it performing any better?
Yeah, as compared to the eastern market, yes, we can say that. The west of Suez market is showing bit more promise. It has been moderately busy week for the west, with December laycans continuing to be fixed. And we have seen a few optimizations along the way. Freight rates for the Houston Chiba route, for example, have risen around $105 per metric ton. The tightening of tonnage supply combined with a steady flow of cargoes has definitely helped to improve the market sentiment. Several fixtures were also reported in the West US Gulf, that is the Houston Chiba route, particularly for the late December, which is helping to clear out relets and gradually push rates higher. However, there is some caution in the market, especially looking into the early January laycans. US cargoes for that time are already well supplied with relets, so owner may face challenges maintaining a bullish market as we head into 2025. Still, the Western market is in a better position as compared to the East, and if this momentum continues, we could see some further rate increase.
Thanks, Akhilesh, for your insights on the LPG market. Now, I guess this brings us to the end of today's episode. To all our listeners, thank you for tuning in to this week's episode of the Weekly Tanker Market Podcast. Do not forget to share, subscribe, and follow us on social media. Before we sign off, on behalf of Saigal Sea Trade, I'd like to extend a warm welcome to all our participants and audience. For those who may be new to Saigal Sea Trade, we are proud to be one of the largest and most prominent shipbrokers and maritime consultants in India. With over 100 dedicated professionals specializing in the dry bulk and tanker markets and the offices in Delhi, Mumbai and Ahmedabad, we are always available to support our clients, be it through regional presence or via phone, email and social media. We also have a dedicated research department that collaborates closely with Indian stakeholders across shipping and commodity sectors, delivering in-depth and timely market insights through weekly and monthly reports. If you'd like to learn more, feel free to reach out to us. Until next time, navigate safely and stay